Now, Wall Street was also buzzing about some provocative comments from former Federal Reserve Board member Kevin Warsh. He described the Fed's easy money policies as benefiting the rich at the expense of the poor.
If you have access to credit, if you've got a big balance sheet, the Fed has made you richer. And so I would say this has been, in some sense, reverse Robin Hood. This is a way to make the well-to-do even more well-to-do, because that's what the Federal Reserve can do.
And Warsh suggested that raising the benchmark interest rates would help jumpstart business investment and speed up economic growth.
So, is Kevin Warsh right? Our next two guests have opposing views on that. Gus Fauché agrees with him. He's senior economist at PNC. Brian Westbury disagrees. He's chief economist at First Trust. Gentlemen, welcome. Gus, why do you agree? Why is this a reverse Robin Hood situation here?
Well, the Fed policies certainly are making the well-off even wealthier. We've seen big gains in stock prices. We've been seeing big gains in home values, and those have benefited wealthy households. But that's a side effect. That's not the goal. That's not what the Fed is trying to do. They're trying to support economic growth that benefits everyone, and the side effect of that is to make households wealthier.
All right. So, Brian, your turn. Make the case for the opposite argument.
Sure. Well, first of all, if you borrow a lot of money with low interest rates that the Fed is providing, or if you're going to benefit more than if you lend money, right, with low interest rates. So if you want to try to separate the high income and the low income by how much, whether they borrow or lend, then you might be able to make that case. But I don't believe that quantitative easing and low interest rates and Fed activity is why the stock market is up. And you know, you just reported Nike, or think of Apple. I mean, these companies are making new products. They're selling them. They're helping their customers. It's not because of what the Fed is doing. And those companies that are doing this are getting wealthy. And so to blame it all on the Fed, I just think is a mistake.
Gus, what about that? There might be those who would argue that fiscal policy, tax policy out of Washington has as much to do with that, the separation of the wealthy from the middle class these days, as monetary policy.
Oh, absolutely. It's not just a monetary policy story. You know, certainly what's going on with taxes, what's going on with spending. We've seen benefit cuts, spending cuts at the federal level, and so that has hurt low and middle income households. That's part of the story, but I think the Federal Reserve has played a role as well, not deliberately, not trying to benefit the wealthy, but as a side effect of trying to get economic growth restarted.
Brian, I want to pick up on what you were talking about, investment approaches. I mean, if low interest rates have been good for the stock market, and if you're an investor, whether it's through your mutual fund or your pension fund or your 401k, you've benefited. Isn't that a good thing?
Yeah, well, it is, but there's a couple of points here I'd like to make. Number one, it's not low interest rates that are boosting stocks. It's earnings that are boosting stocks. We're at record corporate earnings right now. Our companies in the United States have never made this much money, and they're making this much money because they're more productive, more efficient. We have fracking, 3D printing, robotics, the cloud, smartphone, tablet, apps. All of these things are making us more productive, more efficient, more profitable. That's why stocks are up, not because of what the Fed is doing. And my second point, to go to what we just heard, the government has not cut spending. It's not cut redistribution to individuals. To say that's just not true. In fact, I believe the bigger the government is, the more taxes we have, the more we try to help people, the worse we make the middle class.
All right. Well, let's reverse this then, Gus. Let's say when interest rates start to rise, does that then disproportionately hurt the wealthy who have benefited to this point?
No, I think if interest rates are rising, that's because the Federal Reserve thinks that the economy is doing better and can withstand higher interest rates. I think what the Federal Reserve is trying to do is trying to lift all boats. We want a stronger labor market that benefits workers so they can see wage gains, they can see more jobs. And if the Fed is raising rates, that's a signal that they think that that's occurring. So it's not a question of who wins or loses. It's a question of how do we all benefit from stronger economic growth.
Well, so Gus, how do we fix this income inequality situation?
How much time do you have? I mean, you know, that's a huge issue, and obviously if we had the answers, I wouldn't be here today. You know, there are a whole bunch of issues that need to be resolved. But the question is, workers are more productive. We're absolutely right about that. The question is, how do workers benefit from those productivity gains? Right now, those gains are going primarily to holders of capital, to business owners, and not to the workers. But we want to have an economy where prosperity is broadly shared.
And Brian, by disagreeing with Kevin Warsh, are you suggesting that there isn't an income disparity in the United States right now?
Oh, there's an income disparity. The question is, where does it come from? And my belief is that during times of technological advance, so think about this. Michael Jordan made way more inflation adjusted than Babe Ruth ever made. You could say that they dominated their sports in equal fashion. Why did Michael Jordan make so much more than everybody else? Well, it's because of TV. He was a worldwide sports star. And that's the same with technology. Microsoft sells their software to 6 billion people in the world, not just to 3 million people in Chicago, let's say. And so as the global market opens up and as technology broadens things out, there's going to be people that benefit massively compared to the average.
All right, let me just ask real quickly from both of you, just a few words. How long is it going to take for the middle class to feel good again? Maybe not as good as Michael Jordan, but to feel better than the way the situation is now. Gus, you first.
I think in about a year. I think we'll see consistent job growth of 200,000 per month. We'll see the unemployment rate continue to fall. That will lead to a tighter labor market and an acceleration in wage growth, and households will be feeling better by this time next year.
Brian?
Sure, I won't disagree with that. I think households are already feeling better today than they did a year ago or, say, 3 years ago. We can see it in consumer confidence data. But to really get back to the 80s and 90s or 50s and 60s when most people felt good about the future, we have to cut the size of government. We can't have taxes this high and spending this high and ever hope to achieve that level of prosperity that we got used to in the 80s and 90s.
Good conversation, Gus. Brian, good to see you both. Thanks for joining us tonight.
Thank you.